Okay, guys, so for chapter 1, and April editing, here we go. So for chapter 1, we're going to just do a brief overall understanding of managerial accounting. Now, those of you that were in financial accounting know that we measured activities and we came up with financial statements to communicate that information to external users, such as people outside the company. In this classroom, we are going to provide information to the managers within an organization so they have a way of making their processes smoother, cheaper, easier, whatever that is. As it says here, formulate plans, control operations, and ultimately make good decisions. We classify various costs. And the way in which we do that, we assign costs to what we call cost objects. Accounting for costs in manufacturing companies is a whole different animal than when we do it in the service industry world. We're going to learn then how we're going to prepare financial statements based on the inventory that happens with manufacturing companies. We're going to predict cost behavior, meaning when activities change, we should be able to then determine how costs are going to change with those activity changes. Ultimately, all this is about making decisions, providing the users with helpful information that is going to allow them to make smart decisions. First thing we're going to do is understand cost classifications. We have two primary types of costs. One we call direct costs, and one we call indirect costs. Direct costs can be easily identified and traced to a specific unit or cost object. Examples of direct costs are direct materials and direct labor. Think of an automobile factory. Direct materials may be the metal, maybe the radio put in the automobile, maybe the leather, the seats, the rugs, the glass for the windows. Does that make sense? The direct labor would be those individuals, if they're not just robots, working on that factory line. Those are direct materials, direct labor. Indirect costs are costs that can't be easily traced to a unit or cost object. It might be the grease for the machines. It may be the cafeteria in the factory for users to go, or for the employees to go eat. So it could be the electricity. So you need the electricity to run the factory so you can work on the cars, but it's not directly linked to an automobile. There's a lot of costs that are indirect costs that are not directly linked to that specific automobile. We call those indirect costs. Okay? Northwest Hospital is a full-service hospital providing everything from major surgery and emergency room care to outpatient clinics. For each cost incurred at Northwest Hospital, indicate whether it would most likely be a direct or indirect cost. So what I'm trying to do here is just start getting our minds thinking of how this works. So for example, catered food served to patients. If our cost object is a specific patient, is that a direct cost? Yeah, we can see what food's going to that patient, can't we? If the cost object now is the pediatric department of the hospital, the wages of the pediatric nurses, is that a direct cost to that department? Yeah, you can identify, here are the 5 nurses, here they're in this department, direct. Prescription drugs for a particular patient. Can you assign it directly? Yes, you can, can't you? Okay, what about this one though? The pediatric department, okay, it might occupy 10,000 square feet. The heating the entire hospital, isn't that an indirect cost, guys? Do you know which heat's going for that department? No. Does that make sense what I'm trying to get at, direct versus indirect? Next, the salary of the head of pediatrics. If the cost object is the pediatric department, we can define that. That's a direct cost, couldn't it? Wouldn't it be? But guys, what about this one? The salary of the head of pediatrics for an individual patient? That's an indirect cost, isn't it? That specific patient, huh? The salary for the whole pediatric department, that's indirect for that particular patient, though. Or the hospital chaplain's salary, that's indirect. How can you take that chaplain and assign it to just this patient? You can't. Does that make sense? Or what about lab tests by outside contractors to a particular patient? You can determine which lab tests were for that patient. And you can also determine which lab tests were for the whole pediatric department, couldn't you? Does this help you see how, depending if it's a particular patient, we can assign direct costs to them, or we might have to lump them in the indirect cost category? And the same with a department. So it's important when we are talking about costs, sometimes they're going to be direct, sometimes they're indirect. Now, there are, when we have manufacturing costs, such as this automobile factory, we're going to have direct materials, which we just talked about, that's associated with the product, the direct labor, that labor associated directly with that automobile. And then we're going to come up with this other category that's huge called manufacturing overhead. Manufacturing overhead, okay, direct materials are the raw materials that become the key part of the product, such as a seat installed in an aircraft. We can determine that seat directly to a cost for that aircraft. Or we can assign wages for someone who's installing the radio. But this manufacturing overhead is huge. It includes all manufacturing costs except direct materials and direct labor. These costs cannot be readily traced to a finished product. So it includes indirect materials and indirect labor. Remember me talking about the cafeteria staff or the janitor? They aren't directly working on that automobile, but they still have a need to be there, and it is still a cost in making that product. But they are all lumped into manufacturing overhead because they aren't directly associated with that product. Some examples of manufacturing overhead: depreciation on manufacturing equipment, utility costs, property taxes, insurance premiums to operate the facility. Indirect costs associated with operating the factory are all included in manufacturing overhead. Yes? It, so if they are starting the manufacturing company and they're purchasing the equipment, we would wait until the factory starts before we start depreciating it. But that equipment, the manufacturing equipment, would be part of manufacturing overhead. It, it becomes part of the overhead, correct. So what happens is once a, a factory is put into service, meaning once they begin doing the work, then you start depreciating. Good question, so thank you. Now, so we have direct materials, we have indirect materials, we have direct labor, indirect labor, and we have this big thing called manufacturing overhead that includes everything not directly associated with the product, okay? We also have some concepts, cost concepts we want to know about called prime costs and conversion costs. Know this, prime costs just include direct material and direct labor. Conversion costs are direct labor and manufacturing overhead. You're going to get questions about this on the quiz because I was working on them and it's like I saw them everywhere. Prime costs include what? Direct material, direct labor. Conversion costs, direct labor, and manufacturing overhead. Non-manufacturing costs mean they're not even part of the product. Manufacturing costs are part of the product. Non-manufacturing costs are what we call period costs. Period costs flow right to the income statement as an expense of the period. Any costs necessary to secure the order and deliver the product are selling costs. They go on the financial statement in the period in which they are incurred. They're not part of the product and carry with the product till it's sold. These are period costs. Administrative costs include executive, organizational, and clerical costs. They are also period costs, which means they go right to the income statement and get expensed in the period in which they are incurred. The PC Works assembles custom computers from components supplied by various manufacturers. The company is very small and its assembly shop and retail sales store are housed in a single facility in Redmond, Washington Industrial Park. Listed on the next slide are some of the costs that the company incurs. For each cost, indicate whether it would most likely be classified as direct materials, direct labor, manufacturing overhead, selling, or an administrative cost. The cost of a hard drive installed in a computer. You think that's a direct material cost? I think so, right? The hard drive is tangible that's going into that computer. What about the cost of advertising in the Puget Sound computer user newspaper? Isn't that a selling expense? That will be expensed on the income statement. It's not part of the product cost. It doesn't follow the product until it's sold. Selling and admin expenses go straight to the income statement. Next, the wages of employees who assemble computers from components. What would that be, guys? Don't you think it's direct labor? Okay, next. Sales commissions paid to the company salespeople. Selling, right? Next, the salary of the assembly shop's supervisor. It's not a direct labor, is it? Wouldn't that be under manufacturing overhead? Am I losing you guys? Is it kind of clicking? Next, the salary of the company's accountant, administrative, wouldn't it? Depreciation on equipment used to test assembled computers before release to customers. Manufacturing overhead. It's not really linked to a specific product. Rent on the facility. Yeah, manufacturing overhead. Combination of manufacturing overhead, selling, and admin. Okay. The rent would most likely be prorated on the basis of the amount of space occupied by the manufacturing department versus the admin and selling departments. So you see how we go about categorizing these costs based on these new concepts we've gathered: direct materials, direct labor, manufacturing overhead, selling, and admin. Now, there are product costs and there are period costs. Product costs include all the costs involved in getting this product completed. Product costs attach to a unit of a product as it is purchased or manufactured, and they stay attached to each unit of product as long as it remains in inventory waiting to be sold. When we are manufacturing goods, that is an asset on our books until we sell that product. From when we sell the product, if you guys remember this in financial accounting, it then shows a revenue component and it then shows a cost of goods component. You know what I'm talking about? That product stays as a current asset inventory until it's sold. Once it's sold, it's removed as an inventory item and it's expensed under cost of goods sold. Does that make sense? So all these costs that we're talking about to manufacture products, we call them product costs, and they stay on the balance sheet as a current asset as long as it's not sold. But the minute it's sold, it then gets converted to cost of goods sold. For manufacturing companies, product costs include raw materials, all materials that go into the product. Work in process consists of units of product that are only partially completed and will require further work before they're ready to be sold. And then finished goods, goods that are totally completed, just waiting to be sold. When direct materials are used in production, their costs get transferred from one inventory account to another. So under the guy's inventory, we have all kinds of products. We have got raw materials, we have work in process, we have finished goods. When raw materials are requisitioned from the raw material warehouse to production line, we transfer it from raw materials and we put it in work in process. When direct labor and manufacturing overhead costs are being used because we're working on products, that then gets transferred into work in process. And ultimately, it stays in work in process until the goods are finished and ready for sale. Once those products are completed, their costs are transferred from work in process to finished goods. Then finally, when the manufacturer sells its finished goods, it goes out of the finished goods inventory to cost of goods sold, which is an expense on the income statement. Correct? So, cost classifications for preparing financial statements. We understand that as long as goods are sitting in inventory, they're an asset or a resource. and they will stay on the balance sheet. When they finally are sold, they are off of the balance sheet and they become a cost of goods sold on the income statement. Got it? All period costs, such as selling and administrative, never are product costs. They always go right to the income statement. Okay? Any questions so far? So which of the following costs would be considered a period rather than a product cost in a manufacturing company? Manufacturing equipment depreciation, property taxes on corporate headquarters, direct material costs, electricity costs to light the production facility, sales commissions. Any ideas? Thoughts? Sales commissions is a great one. And property taxes on corporate headquarters would also be a period cost. Now, let's look at this. Suppose you've been given a summer job as an intern at Isaac Aircams, a company that manufactures sophisticated spy cameras for remote-controlled military reconnaissance aircraft. The company, which is privately owned, has approached a bank for a loan to help finance its growth. The bank requires financial statements before approving the loan. Classify each cost listed on the next slides as either a product cost or a period cost for the purpose of preparing financial statements. So I'm going to give you like 2 minutes. Look at these and tell me what you think. Okay, what do you guys think? Depreciation on salesperson's cars. Is it part of the product? No. Period costs. Okay. See what we're doing here? Rent on equipment used in the factory. If it's used in the factory, guys, it's going to be a product cost, won't it be? Lubricants used for machine maintenance. Won't that be a product cost? Next. Salary of personnel who work in the finished goods warehouse. Are they making the product? See, they're not making the product. The product costs are all part of creating that product. If they're in the finished goods warehouse, it's done. They're period costs. Okay, guys? Soap And paper towels used by the factory workers at the end of the shift, product cost, wouldn't you think? Factory supervisor salaries, product. Heat, water, and power consumed in the factory, product. Materials used for boxing products for shipment overseas, period. It's not making the product, period costs. Advertising costs, we know are period costs, right? Workers' compensation for a factory employee, product costs. Depreciation on chairs and tables in the factory lunchroom, period, product. Admin is always period. Anything with selling and admin is always period costs. Cost of leasing the corporate jet used by the company's executives, period. The cost of renting rooms at a Florida resort for the annual sales conference, period. The cost of packaging the company's product, well, wouldn't that be a product cost? It's not, they're not selling it, they're not shipping it, they're packaging the company's product. That's part of the cost. Make sense? Now, we're going to look at other costs. There's a lot of understanding in this chapter. We're going to look at variable, fixed, and mixed costs. Cost behavior refers to how a cost will react to the changes in the level of activity. The most common classifications are variable, fixed, and mixed costs. A variable cost is a cost that varies in total in direct proportion to changes in the level of activity. A variable cost per unit is constant. Okay? So, we've got something called a cost driver. The cost driver or activity base is the measure of what causes the incurrence of the variable cost. Could it be machine hours or labor hours or units produced or miles driven? There's some activity or cost that drives the cost, that because of those hours, they can determine how the cost is going to unfold. A fixed cost is a cost that remains constant in total, regardless of changes in the level of activity. Kind of like insurance, wouldn't it, on a factory building? If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes of activities. So we've got fixed costs that can be committed costs or fixed costs that can be discretionary costs. Committed costs are long term. They can't really be reduced in the short term. Discretionary costs could be altered in the short term by management making those decisions. Okay? Here you see we've got to think when we're dealing with costs within what we call a relevant range. In other words, there can be costs that, for example, insurance on this building. Well, as long as we stick within the relevant range of what we anticipate to utilize as far as square footage and number of students, we can stay within a relevant range and keep that cost the same. As you see here, a straight line closely approximates a curvilinear variable cost line within the relevant range. Accountant's straight line approximation, constant unit variable cost. So based on the activity, the total cost can, as long as it's within a relevant range, can stay pretty constant. The relevant range of activity pertains to fixed cost as well as variable cost. For example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. Fixed costs would increase in a step fashion if you add an additional 1,000 square feet. So your rent is going to stay constant if you stay within the certain amount of square footage. Then once you bump up another 1,000 square feet, of course, it's going to up also with it. Does that make sense? The relevant range of activity for a fixed cost is the range of activity over which the graph of the cost is flat. So showing, if all they need is 1,000 square feet, here's the fixed cost. If all of a sudden it bumps up to 2,000 square feet, well, the fixed cost is going to just bump up along with it. Okay? So that's what we mean when we talk about a relevant range. Cost behavior within a relevant range. In variable cost, total variable costs increase and decrease in proportion to changes in the activity level. But per unit, they're going to remain constant. Those are variable costs. Fixed costs in total will remain constant, but per unit, those fixed costs are going to decrease as the activity level rises, and it increases as the activity level falls. It makes sense. If we show students are our driver, per se, and we have a fixed cost of rent, well, the more students we have to be in a class, per student, those costs decrease if we have more students. Or in this class, if we have 5 students, the cost per student is going to increase because there's one instructor for 5 students instead of one instructor for 40 students. Does that make sense? But there's nothing you can do about it. It's a fixed cost anyway. It's just the more the activity is or whatever that driver is, it's going to benefit you. Guys, which of the following costs would be variable with respect to the number of ice cream cones sold at a Baskin Robbins? The cost of lighting the store, the wages of the store manager, or the cost of ice cream and the cost of napkins? You see, in terms of ice cream cones, the more ice cream cones you have, the more cost you're going to have, the more napkins you're going to have, right? If the driver's the number of ice cream cones. Now, let's look here. Listed on the next slides are costs of providing an airline service. Classify each cost as either variable or fixed, direct or indirect. Consider the cost object to be the flight, okay? The flight, taking off and landing. That's our object. Flight attendants and pilots are paid based on the hours of flight time. So, advertising. Is advertising based on that flight? A fixed cost, a variable cost, direct or indirect? Advertising, no matter what, they pay per whatever. Advertisement, radio. But it's an indirect. When we think of that flight, isn't that an indirect cost? How about beverages served on the plane? Isn't it variable based on the number of passengers? And aren't those beverages directly linked to that flight? The regional VP salary is fixed and it's not directly related to this flight. It's an indirect cost. Same with the depreciation on the ground equipment. That's not linked directly to this flight. Fuel, I'd call that variable and direct. They know how much fuel they're putting in there, don't they? And it's going to be based on how far they go. Flight attendant wages is going to be direct and variable. Same with the pilot. But what about that aircraft manager's salary? Isn't that an indirect cost to that particular flight? Make sense? A mixed cost contains both variable and fixed elements. In this case, utility costs. There might be a fixed monthly utility charge, but then depending on air conditioning, like today, I think my air is going to be going down, like meaning it's going to be pumping a lot today. So you've got a variable amount based on the kilowatt hour. Okay? The total mixed cost can be expressed as an equation y equals a plus bx. So you see, the mixed cost is a certain amount of the fixed cost along with that variable component. If your fixed monthly utility charge is $40 and your variable cost is 3 cents per kilowatt hour, your monthly activity level is 2,000 kilowatt hours. What's the amount of your bill? It's going to be the 40 plus the 3 cents times 2,000 hours. Okay. Now we have all these other thoughts. We've got items called differential, items called sunk, and opportunity. I think I'm going to go back in a minute because we haven't discussed this yet. Okay, so let me go here and then look here. Decisions involve choosing between options. The goal of making decisions is to identify those costs that are either relevant or costs that are either irrelevant to the decision. To make decisions, it's essential to have a grasp on the concepts of differential costs and revenues, opportunity costs, and then things called sunk costs. So differential costs is the difference in cost between two alternatives. A difference in revenue between two alternatives would be called differential revenue. Both are, though, relevant to making the decisions. And differential costs can be either fixed or variable. Opportunity cost is the potential benefit that's given up when one alternative is selected over another. These costs aren't going to be in any records, but yet you have to consider them. Such as, you're in this class, what are you missing? The opportunity cost, you can't work because you're in this class. You can't work at this time. What is the opportunity cost you incur by attending class? It's just the reality. Sunk costs are costs that have already happened. Sunk costs are irrelevant. You can't do a thing about it. Why bring it up? Make sense? Sunk costs are done. They're history. In business decision making, a sunk cost is a cost that's already been incurred and can't be recovered. Sunk costs are sometimes contrasted with prospective costs, which are future costs that can be incurred and changed if an action is taken. But sunk costs, they are done. It's gone. Suppose you're trying to decide whether to drive or take a train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, Should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? I think it would matter, because won't you evaluate, well, here's the cost of the train versus the cost of me driving and parking, right? Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash. You don't want to waste money. Is the annual cost of licensing your car relevant? No. You're going to have that no matter what. Correct? It's not relevant in making this decision. Suppose that your car could be sold now for $5,000. Is that a sunk cost? No. Sunk costs are costs that have already happened, right? Let's go back to this one here. So for each of these, we're going to, Northeast Hospital's radiology department is considering replacing an old inefficient x-ray machine with the state-of-the-art digital one. The new machine would provide higher quality x-rays in less time and at a lower cost. It would also require less power and would use a color laser printer to produce easily readable x-ray images. Instead of investing the funds in the new x-ray machine, the laboratory department is lobbying the hospital's management to buy a new DNA analyzer. For each of these items, indicate by placing an X in the appropriate column whether it should be considered as a differential cost, a sunk cost, or an opportunity cost in the decision to replace the old x-ray machine. So, the cost of the old x-ray machine has already happened. The salary of the head of the radiology department, wait, where am I going? I'm sorry, guys. Is none of them. The salary of the head of the lab department is nothing. The cost of the new laser printer is a differential cost. We would add that cost in one option over another. In terms of the rent on the space of the radiology, it doesn't apply. The cost of maintaining the old machine is a differential cost. It's one or the other. The benefits of the DNA analyzer is an opportunity cost if they get it. And the cost of electricity to run the machine would be a differential cost. Okay? Got those. As you see, the salary of the departments are none of them, and the rent occupied on the space is none of these. Just so you knew that. Okay. Sorry about that. I had the slides backwards. Now, how do we prepare income statements for merchandising companies using the traditional format and then something new we're going to talk about, a contribution format? The traditional format is just the sales minus your cost of goods sold, comes up with a gross margin, and then you've got the selling admin to come up with your net operating income. That's what we see in the financial statements provided to external users. But this contribution format can be really beneficial for management. You take the sales and then you subtract out the variable expenses on those sales to come up with what we call the contribution margin. That amount we get to contribute to fixed expenses to then come up with net operating income. The end result's the same. It's just provides you with information used for different purposes. For management, this is helpful to see what is available for the company to use towards those fixed expenses. It's used as an internal planning tool. We're going to look at this contribution statement in various chapters that we're going to come up with. Chapters 5, 6, 8. It's going to come back again, but you're going to learn about it. So here we have Marwick's Piano purchases pianos from a large manufacturer for an average cost of $2,450 per unit, and then sells them to retail customers for an average of $3,125 each. The company's selling and administrative costs for a typical month are shown here. Okay, so we've got advertising costs, salaries, the delivery of the pianos, the utility costs, depreciation, okay, all the costs. During August, Marwick Pianos sold and delivered 40 pianos. So they want us to prepare a traditional income statement first, then a contribution format statement. Okay? So you see here the traditional statement for August shows you the sale of the pianos, the cost of goods involved, and then all of our selling and admin expenses. Okay? Net operating income of $8,000. Now the contribution format shows the total sales, shows the cost of goods, the variable expense here, shows the variable expense of the sales commissions, shows the variable expense of delivery of the pianos, and shows the clerical cost variable per piano. So then you have the total variable expenses, total and per piano, and then your contribution margin that gets to go towards the fixed expenses. Then you see your fixed expenses with net operating income of $8,000. Now they asked a question here. Refer to the income statement you prepared at the contribution margin. Why might it be misleading to show the fixed cost on a per unit basis? So fixed costs, no matter what, are still constant. But as you sell more, the fixed costs per unit go down. As the activity level increases, the fixed costs will decrease on a per unit basis. Showing those fixed costs on a per unit basis might mislead management, thinking that those fixed costs behave in the same way as the variable costs behave. But the fixed costs don't behave that way. It's a flat amount no matter what's sold, correct? For this reason, fixed costs are generally shown only in totals. Okay? So here we've got Dake Corporation's relevant range of activity is 3,200 units to 8,000 units. When it produces and sells 5,600 units, its average costs per unit are as follows. So if 4,600 units are produced, the total amount of indirect manufacturing costs incurred is closest to what? Guys, this exact question and ones just like it are on this quiz this week. So let's really pay attention to the answer here because you're going to see it again. I promise you're going to see them a couple times. So the relevant range in this example is 3,200 units. Okay, so they're showing, and we're looking only at indirect manufacturing costs. So what are some indirect manufacturing costs, guys? Wouldn't they be the variable manufacturing overhead and the fixed manufacturing overhead? Wouldn't it? The indirect costs? So if the relevant range is at 3,200 units, do you see that the way they figured the variable or the fixed, they took the $3 per unit, and we have to take it at 5,600 units, okay? The reason we're taking it at 5,600 units is because it's saying here when it produces and sells 5,600 units, its average cost per unit are all shown here. So it's showing $3 at the 5,600 units. So we need to show the $3 times 5,600 units. Why? Because it's fixed anyway. It's not going to change. Remember, fixed costs aren't changing. Okay? So when we come up with the variable manufacturing overhead, we're going to take the $1.30 times our 4,600 units that we produced. But we still need to take all the fixed manufacturing overhead, don't we? Because they're not going to vary per unit. We're going to still have to take all of them. So in this example, our total indirect manufacturing is the $1.30 times 4,600 units, and then all the fixed manufacturing overhead, 16,800. Because again, this figure of $3 is based on fixed manufacturing of 5,600. So we got to take that whole amount. Does that make sense, guys? Okay. Which of the following would likely not be included as manufacturing overhead in a furniture factory? Which of these do you think won't be? Anything? The cost of the glue in a chair? The amount paid to the individual who stains the chair? The workman's comp insurance of the supervisor who oversees production? The factory utilities. So manufacturing overhead are indirect costs. Okay? Which would not be included as manufacturing overhead? Well, what about the cost of the glue and the amount paid to the individual who stains the chair? Wouldn't those be? I didn't mark it, but I promise you those are the correct answers. Right? PERT's relevant range of activity is 3,000 units to 7,000 units. When it produces and sells 5,000 units, its average costs are shown here. So the manufacturing overhead, guys, the variable is variable. The fixed is fixed. So when we see that the fixed manufacturing overhead is $3 per unit on 5,000 units, then that's 15,000 bucks, right? That's fixed. So we need to use that 15,000 bucks no matter what we produce. If 4,000 units are produced, the total amount of manufacturing overhead is closest to, what do y'all think? Do you think it's C? You're perfectly correct. So we see the variable plus the 15,000 gives us our 21,400. Excellent. Same's going to happen here, guys. The same concept. The total amount of, now this is direct manufacturing costs. Okay, so the question is here, Berry's relevant range is 2,000 to 6,000 units. When it produces and sells 4,000 units, its average cost per unit sales are as follows. If 3,000 units are produced, the total amount of direct manufacturing is direct materials and direct labor, correct? So in this case, 3,000 times $10.05, the direct materials and the direct labor. Does that make sense? They didn't ask us about manufacturing overhead this time. They asked us about direct manufacturing costs. Here we've got Murray's department. The Murray store is just one of many stores owned and operated by the company. The shoe department is one of many departments at the Murray store. The central warehouse serves all of the company stores. What is the total amount of the cost above that are not direct costs of Murray store? Well, it told us that the central warehouse is for all stores, correct? And the corporate legal offices, that wouldn't be direct costs of just this Brentwood store, would it be? Or would the corporate headquarters, would that be a direct cost? No, it wouldn't, right? So wouldn't it be the corporate legal office salaries and the corporate leasing building and the warehouse lease costs? If you total that up, that $157,000 are not direct cost of Murray store. Make sense, guys? Okay, so guys, what I'm trying to do is show you the examples on the quiz. So these last are actually exact questions that you could have, okay? So look through these. Remember I said that you're going to see something about conversion costs? Prime costs were direct materials and direct labor. Conversion costs are direct labor and manufacturing overhead. So direct labor and manufacturing overhead, 29.1 and 26.1. Would that be the 55.2? Okay. Again, here's another example. Figuring out a contribution margin. Gross profit minus variable costs. Okay. So I'm going to have you go through these just so you, I wanted you to really get an experience of what those questions are like for you. Now, in terms of homework, I'm going to finish this slide now and then we'll talk about that.